Welcome, everyone, to the Move Smartly show. Today, we have a fabulous guest, Ben Rabidoux, who's an analyst at Edge Realty Analytics. Ben is the champion of charts, so we're really glad to have him on today. And joining us is my co-host, co-contributor, John Pasalis. John, you're in New York, and you told me you're just going to chime in.
I'm going to chime in here, and I didn't want to miss the opportunity to be on with Ben and hear some of his thoughts and chat a little bit about real estate, but we're going to let him talk more about the macro stuff that in the research that he publishes, and he publishes a great report for people in the real estate industry, mortgage brokers, real estate agents. I mean, it's a fantastic monthly publication. I subscribe to it. So we're going to unpack some of the stuff that Ben covers in his reports today, and I think a lot of our viewers and listeners can get a lot of value out of it.
Absolutely. So let's jump in. Ben covers both the macroeconomic situation and the impacts on housing. So let's start. As I said, I love all your charts. You track trends from big to small, trying to create a picture of where the overall economy and housing sector may be going. So we've just seen the Bank of Canada raise its rate again. And there was some language in there suggesting that maybe there's going to be a pause, exactly as you were predicting, Ben, in your latest report, because they want to see what the flow-through effects are and because there are recessionary signals. So what are your data showing in terms of the recessionary signals?
Sure. Thanks so much for having me on, guys, and appreciate the kind words off the bat. The Bank of Canada is starting to acknowledge that the interest rate hikes that we've seen are going to take a while to filter through the economy, right? And so a central bank never wants to get too far out over its skis. So we've seen the overnight rate go from 1/4 point to today 4.5, and that's the most dramatic increase in interest rates we've seen since the 1990s. And so we don't really know yet how that's going to filter through to the broader economy. It takes a while for high rates to affect the economy. We know it takes a while for mortgage rates to reset, for business loans to renew, and then for all of that effect to then weigh on consumption and investment decisions. And so there's a saying in central banker circles where they talk about that interest rates have a long and variable lag in terms of how they hit the economy. And so we don't really know yet. So it's a smart thing for them to do to now take a pause and just gauge the impact. Now, in terms of what we're seeing on the economic data, it's interesting. There's the forward-looking indicators. If you look at something like the OECD's composite leading indicator, absolutely flashing recession, right? It's the most rapid 6-month decline that we've seen outside of the financial crisis in 08-09. Other indicators like the yield curve is certainly flashing recession. But when you look at other indicators like the labor market, job vacancies, credit card delinquencies, and granted, those are more lagging indicators. They tend to roll over a little after the economy softens. But it is remarkable just how strong the labor market continues to be. I mean, I think if you'd asked John and I a year ago, could the Bank of Canada raise rates 4.25% and not have the labor market fall apart? Like, I think we probably would put them in like, there's no way, right? Canadians are too sensitive to high rates. We're too indebted. But here we are. We've got an unemployment rate that's still basically at record lows, just over 5%. We still have 850,000 job vacancies across the country. That's remarkable. We've got consumer insolvencies they're trending up, but they're still not back to pre-COVID levels. And so it has been surprising just how resilient the Canadian consumer has been. I think we're going to have a very different view of that in the back half of 2023, because that's where I really think the rubber is going to start to meet the road, and we'll start to see those impacts of those rising rates.
Yeah, I actually just love that you started with that, because there are different indicators sort of going in different directions. And you had a great quote from your report. It's difficult to make sense of it all, but thankfully we don't have to. The ultimate arbiter of truth in these matters is the bond market, which takes all of these signals and distills it down to one meaningful price. And here the story couldn't be more clear. Bond yields are falling hard in anticipation of a weaker economy and a Bank of Canada rate hike pause on deck. So I was comforted by that, Ben. It was like, oh, okay, there's one thing that'll tell me what's going to happen. Can you unpack for us what the connection is between the bond market, how it tells us where the Canadian economy is likely to go, And then maybe after that, let us know the impact on housing.
Sure. The bond market is ultimately a reflection of future expectations of measures like the economy, inflation, and then ultimately what the central bank will have to do in response to that. And so it's true, like if you sit here and you look at all these economic indicators, you're like, well, how do I make sense of this? How do I think about this? You got one going up, you got one going down. It's all over the place. And it's the job of the bond market, bond traders broadly, to distill all that down into one price signal, which is effectively bond rates or bond yields. And those bond yields, particularly the 5-year bond yield, it matters a lot for mortgage pricing in Canada, right? It's really the main input into 5-year fixed rate mortgages, which remain the most popular term in Canada. And what's very interesting right now is, we can see that the 5-year bond yield in Canada has rolled over quite meaningfully. And it's suggesting that we may see mortgage rates drop on a widespread basis into the low 4s or potentially even into the high 3s this spring if we get a really competitive spring market. That's typically what we see in Canada is the banks get really aggressive in the spring. They compete hard for customers. They undercut each other on rates. And so where the bond market is trading right now, it looks like we should be in that kind of low 4s. But if you get a bit of competition, I mean, who knows? And so all of that could matter a lot for housing this spring. There's a huge difference between 5.5% mortgage rates and 4% rates at this point, I think. And so, yeah, the bond market is telling us quite clearly that it does not. I mean, there's a lot of fear that we're going to see 8% mortgages and some of these really high, and the bond market's telling us quite clearly that's not in the cards for right now. Things could change. I mean, you need a lot to change. You know, inflation would really have to take back off again. But as it stands right now, it certainly looks like we've seen at least an interim high in mortgage rates for the time being.
And so Ben,
I'm gonna jump
yeah.
in. Actually, I think Ben raised a good point, and it's something we don't hear about as much. I mean, a lot of commentary about, you know, the Bank of Canada is not changing rates anytime soon, which is likely correct, right? But I think the point that Ben made, which is an important one, we have to keep in mind how it might impact housing, is that 5-year mortgage rates are set by the bond market, not the Bank of Canada. And usually bond yields and by extension 5-year mortgages are likely going to decline before the Bank of Canada starts cutting, right? And that's kind of what Ben's talking about. Like, we could see mortgages in the 4%, which is like a full 1.5% below kind of the peak. We were at 5.5% interest rate for 5-year mortgages. And if we end up at 4, that could be a huge difference. And when we think about the dynamics even on the demand side, yeah, that could have an impact. And I don't think we're going to go back to a booming market, but certainly, you know, going back to 4% is a very big difference compared to 5.5%, which is where we were.
Yeah, and maybe just one final thought on that. It is interesting because you're right. Normally, we have fixed rate mortgages. Let's use a 5-year term. 5-year fixed rate mortgages are typically priced above variable because there's a cost to locking in, right? The banks have to factor that in. But what we find today is it's a bit inverted. If you want to take a variable rate mortgage, you're about 40 bips above, like 0.4% above a comparable term fixed rate mortgage. And we really haven't seen that in the past decade. It's deeply inverted. And that tells us that the bond market is expecting that those rates are going to be coming down.
And just to break that down really basically or simply, the reason why the bond market is sort of predicting that the rates will come down is because the economy, all the signals they're seeing point to a slowing economy. And so the rate, you know, the need to spur it or at least the need to stop the inflation or the runaway will start attenuating, and then we'll have the opposite problem. Is that basically what they're coming down on?
Exactly. So the purest measure of the market's expectation for the Bank of Canada is called the overnight interest swap, and it's so the OIS market, and you can plot it on a curve, so you can actually see where people expect the overnight rate to be at various points in the future. And what that curve is telling us is that economists and traders are expecting the Bank of Canada will begin to cut rates in the 4th quarter. Now, I personally, and this is where we can start getting into predictions, I personally think that's maybe a little bit aggressive. I would be surprised if we see the Bank of Canada cut rates this year, unless the economy really starts to fall apart, only because central bankers live and die based on their credibility. It's the most important thing for them. And we have to be honest here, the Bank of Canada lost a ton of credibility with the public this year, right? It was like a year and a half ago that you had Tiff saying, you can feel confident going out there and borrowing all this money and buy that house, and you can be confident that rates are going to stay low. And then like a year later, he's just killing everyone with these rate hikes. And it was clear in hindsight that they waited far too long to begin tightening, and then had to overcompensate and cause a lot of arguably unnecessary harm on consumers. And so they don't want to risk that again. And so even though the market is pricing in some rate cuts later this year, it's really hard to get there unless we see a really, really nasty outcome in the economy.
Yeah, so it's kind of like analogous to braking or speeding up in a car too fast or too late. If they were to start lowering rates and then all of a sudden inflation starts ticking back up, I mean, that would look horrible if they then have to turn around. And I understand from the data, there was a time, was it after the last recession, I'm not sure if it was 2008 or even in the 90s, where there was a little bit of a V shape, and bankers sort of have the fear of that.
I think it was Volcker in the 80s, who kind of cut too quickly, and
yeah.
Well, the reality is typically these inflationary cycles, they come in waves, right? It's not usually a one and done. If you look back over these inflationary bouts, they tend to kind of come in these rolling waves. And I think that's probably what we're going to see here. And this is getting a little off topic as it relates to housing, but I'm very much of the view that we're going to see more elevated inflation than we're used to for quite a period of time, right? We've been used to inflation that's been running, the Bank of Canada has a 1 to 3% target, but really it's been at the lower end of that. We've seen inflation in the 1% range for most of the past decade. And if you start to think about what are the factors that have driven this disinflationary trend, not just over the last decade, but really over the last 30 years, it's been things like, labor arbitrage globally, right? Being able to manufacture very cheaply in some parts of the world. That's by and large, that's gone now. We don't have big pools of excess labor in the world, right? Globalization, being able to have supply chains running all over the world cheaply. Well, who wants their supply chain running through Russia or China right now? Like everyone's doing the opposite. We're trying to bring supply chains home. That's inflationary. And then the big one that I don't think anyone's talking about is just that we've had, if you look at capital expenditures in the commodity space, just raw materials. I mean, we've seen basically a decade of declining capex. And what that tells us is we're investing less in finding those raw materials. And typically when you go through a period where you don't have a lot of investment, it means things become more expensive. You have less of it for a while. And I do wonder if we're not going to see higher commodity prices, higher energy prices, and all of that will conspire to give us inflation that instead of averaging 1% might average more like 3%. And that doesn't sound like a big jump, but if you think about what that means for bond yields, right now, all of a sudden we've got 5-year bond yields that are no longer 1.5%, maybe they're 3.5% sustainably, which means that mortgage rates are no longer 2.5%, 3%. Now they're like consistently 4.5%, 5%, 5.5%. And I think that's the world we're going back to. And that's not great news. And I know that there's a lot of optimism in real estate circles that like as soon as there's any economic weakness, we're going right back down to zero with the Bank of Canada. I really don't see that. I think it's much more likely that people are going to be surprised at how, I don't want to say like how much higher, but like, if we settle in around 2.5%, 3% on the overnight rate, that's kind of normal. That's kind of where we probably should be over the longer term. So that's a very different environment for real estate, as I'm sure John could speak to. What consistently mortgages in the 4 to 5% range, what that would mean going forward.
Yeah, let's continue on that with the housing questions. You've talked about in your report how construction starts have really fallen off, and you had some interesting numbers. Let me see if I can see them here. New housing starts showing a decline of 24% over the last 3 months. And you've often noted that when we have a contraction in the housing sector here, so the buildings aren't going up, the people aren't being employed on the construction sites and all the other related industries, it tends to impact Canada's economy quite a bit. For example, I think you've noted construction as a share of jobs is higher in Canada than in the US. So do you expect some of that slowdown in the housing sector itself to contribute to the overall recessionary situation we might see?
Oh, definitely. And I want to be clear that 24% relates to single family specifically. But it's interesting when you talk about leading indicators. Anytime that you have single family starts drop by that magnitude over a 3-month period, it's always been in a recession, right? You can go back as far as you can find the data. Single family starts do not post that steep a decline outside of recessions. And so that's where we are right now. Now, it's a weird dynamic, right? Because on one hand, when housing starts decline, it weighs on the economy. And there are people who would even suggest that the business cycle, the economic cycle really is a housing cycle, right? When housing starts roll over, it just has such an impact on the broader economy that recessions are by and large dictated by the strength of the housing market. That's one opinion. And so when housing starts roll over, it has typically a pretty pronounced impact on construction employment, which is still almost 8% of the labor force, much higher than any point we've seen in any prior cycle. And so that's one side of it, right? Falling housing starts creates this negative loop in the broader economy, weighs on the labor market. But if you roll that forward a number of years, right? Because there's a second side to this, and that is that if we look at the population growth that we're having, and if we assume that this is now kind of the new normal in Canada, and you roll forward population growth for a number of years, and if housing starts continue to trend lower, like it does raise the question of like, are we going to be here in 3 years' time talking about another supply crisis, right? Because no one can expect builders to build new housing into a very weak resale market. And that's what creates these cycles, right? And so if you roll that forward, we're probably going to end up potentially, I don't know, but potentially that's the sort of thing that sets up for another supply crisis down the road.
Yeah, I want to touch on the long term a bit more a bit later, but I was thinking about how we sometimes think that these short term things happen and then we recover from them. But I was thinking about the jobs, the recession, in the early 2000s, when a lot of new graduates were not able to get that first job and get themselves on the rung. And even in my own sector, then it was civil service, there was known as this gap, this age cohort, which never made it on at that time. It was slightly ahead of me and behind the older sector. And they never appeared in the data for years and years later. So it's not as if that gets made up. And I'm starting to wonder if housing starts a bit like that. Do we just keep adding to this gap that grows? Like you can't just all of a sudden catch up. Like all the builders are like, all the building I would have done, I'm now going to make up for, when situations improve.
Yeah, well, that's what creates housing cycles, right? You can't expect builders to build and sell at a loss. And so naturally, when the market is exuberant and there's a lot of demand, builders create a lot of inventory. They try to bring a lot of new supply online. I would say arguably over the last decade, they've not been able to bring enough single family supply online relative to demand and population growth. But at the end of the day, eventually something happens where there's a demand shock. And in housing, it's never like housing demand goes up slowly and then rolls over, goes down slowly. It's like someone throws a match on gasoline and demand explodes. And then it just hits a wall and it falls, right? It's never like this kind of slow build, right? And so because of that, developers are always either rushing to bring supply into an extremely frothy market, or they're stuck with supply when the market rolls over very sharply, like we're finding right now, right? But it's that cycle that creates these, booms and busts. It's what creates the undersupply and the oversupply. And so in a lot of ways, like the housing downturns are what creates the future supply shocks. And you can kind of see that starting to shape up right now.
So it'll contribute to a widening gap. I think some of us are very cynical when we think of the building sector. We just think they're sitting back and plotting, great ways to make pots of gold but I'm getting a sense from you that it is a highly reactionary and risky sector. You're trying to place bets when the conditions are most advantageous, but slight shifts in different factors can really scare off builders like very quickly.
Well, I think not only that, we have a political climate in Canada that's just not very conducive to trying to bring new supply. We have, if you think about how housing is ultimately sort of permitted and that whole process, it has to run through municipalities. And this is something I've talked about at length, but it's not a great system for trying to bring supply because, you know, everyone's in favor of new supply, just not right beside me, right? And so ultimately these municipal councillors have to listen to their next door neighbor, and their kids, friends, parents on the hockey team have to complain. It's like, well, why are you allowing this to go in? And because of that, the bias is towards, you know, pushing back against developers who want to bring new supply. And I'm not in any way, you know, hugely sympathetic or on one side or the other here, but it's a fact that, you know, trying to navigate that approval process to bring new supply is not easy. And I think we're starting to see a recognition from various levels of government that we need to find a way to incentivize municipalities to effectively, you know, ignore the NIMBY crowd, the not in my backyard crowd, that if they had it their way, they would basically own a home and lock the doors to home ownership behind them so that future generations couldn't get in, right? And that's not right. So you've got that going again. So you've also got, as a developer, like trying to bring new supply, you've got these crazy development charges. And it's a weird thing that we do in Canada where we almost subsidize our property taxes. Our property tax rate is relatively low based on the value of our homes. And I know people are going to hate to hear this because everyone hates paying property taxes, but you go to a lot of other jurisdictions, property taxes are much higher.
And excuse me for interrupting, in the city of Toronto, it's even higher than its neighboring municipalities.
Lower.
So we
Toronto's
are
the lowest.
lower,
Toronto's
sorry,
the lowest,
lower,
yeah.
Like we're
Right.
very used to low property taxes.
And so what we do is we subsidize, in a sense, the people who are already in the housing market, and then we raise revenues by layering these development charges onto new builds. And so if you're a new buyer trying to break into the market and you want to buy some new townhome or a condo to get your foot in the door, embedded in that new price are all of these development charges that are jammed down on new buyers trying to get in and are effectively subsidizing existing owners. And I think that's a bad policy. I actually am much more in favor of seeing much higher property taxes and lower development charges. And the reason for that also is that if you think about some of the things that are wrong with housing, or some of the things that potentially, I guess, have been raised as potential issues, things like vacant homes, and we can debate how big an issue that is, and foreign speculation and all of that stuff. And if you think about it, if property taxes were substantially higher, that would disincentivize a lot of that behavior, right? If you want to speculate on a condo in Toronto, and I'm just using a hypothetical here, but let's say, you know, some oligarch that just wanted to park some money in a safe jurisdiction, if my carry was 1% a year or 2% a year, because that's what the taxes are, yeah, okay, that's very different economic calculus than if it was substantially higher. And there are even ideas floating around about, you know, being able to deduct part of those property taxes against local earned income, right? Which is a way of sort of further disincentivizing non-Canadians and foreign capital from being parked here, if that makes sense.
That's interesting. You know, before I always heard this a little bit more in terms of a more local generational problem, like in Toronto, politicians feared going to seniors and other older populations who might be in a nice, expensive piece of property, but don't have, we're on a fixed income. And there always tended to be, and I remember this for years, this argument that, low property taxes are good for all. And then it's almost this user pays kind of mentality started creeping in. And as you're saying, a lot of that, you see that in the development of new housing, but really that lands on the first time buyers, the newest entrants into the market.
Well, one way or the other, right? Because even if it's not the first time buyers buying the new homes, it really doesn't matter, because at the end of the day, it's disincentivizing new supply. And that ultimately hurts people trying to get into the market. So we just need to rethink of how we handle that.
And I wonder if marrying this issue of foreign capital, or at least just capital, like the capitalization of the financialization of housing, rather than this, oh, it's seniors in their home, like that old story is really important to note, actually.
Yeah, but you can
John,
have like in sorry to jump in, but in Vancouver, I know that you can defer property taxes, and effectively it ends up, you accumulate a lien against your home over years. And so if you're elderly and you have a $1.5 million house that you're living in without a mortgage, and you don't really want to pay the property taxes because your cash flow, well, you just roll that, and it builds as a lien against your home, and maybe when you pass away, you owe the city $300,000, and so that comes off the top, and the rest go to your relatives, right? Like, there's ways to do this if that's the big concern, but at the end of the day, everybody has to make sacrifices here if we want a more stable and more balanced market over the longer term.
that's very interesting. There are mechanisms. John, is there anything to add? I think we're in our longer term supply discussion. So I think I want to bring up something else that Ben talked about in terms of the levels that we're building today. But before then, John,
Ben mentioned a couple of things that stood out in terms of this idea of the business cycle and housing supply and demand. And I think one thing we need to keep in mind is, like, in traditional housing cycles, you see this, like Ben said, you see this boom in demand, builders want to build, they want to keep up. And then when things go bad, things slow down, right? And when we look back at the 80s, even in Canada and in the Toronto area, a lot of that demand was fueled by a population boom, actually, right? And builders accelerated construction, and they had tons of building, and a lot were bought on spec or built on spec. And what happened is, when the market turned, our population growth actually declined significantly, right? And what ended up happening is we had this oversupply of housing for a while, which is why we didn't actually build as many homes in the 90s, right? And I think that's important. And that happened actually in quite a few countries during the financial crisis in Europe, like Ireland had a population boom, Spain had a boom, and then, their growth kind of slowed down. And I think, like, when we think about where Toronto's going, I think that is a big factor. Like, I think our population numbers, I remember when they announced them, Ben tweeted out that, he heard from someone in the government that one of the reasons why they're accelerating it is to support housing, right? And it does support housing. If you're growing faster than your ability to build homes, it's going to put pressure on the market. And, it doesn't mean prices are going up 20%, but if it helps plateau prices and, and curb any massive decline, that's also kind of one of their goals. So I think that's going to be interesting. I think it's important to look at over the next year or two how that impacts the market.
So I think I saw a funny graph on Twitter. We were talking about the financialization of housing. Well, there's two parts of that. There's people and capital, and now they're turning to the people part. So just sheer numbers.
That's a good way to put it.
Exactly, 100%. Yeah.
Yeah, I think, was it Suretsky, I think, said something about human QE, right?
Yes.
Like the idea of stimulating with people.
100%.
It is interesting to me. Like, that's a broader discussion around population policies and immigration policies. And I've had a lot to say about this, and it's one of one of my pet peeves that we almost can't have an open and rational discussion about anything to do with immigration in Canada, because people immediately play like this xenophobia, anti-immigrant sentiment card, which couldn't be further from the truth. Like, to be very clear, when we look at just simply the trend in the natural increase, right, which is like births minus deaths in Canada, right? That's trending down sharply. And if you roll that forward a few more years, like, we're going to be outright declining, right? And so you can't be a rational person and oppose immigration, because who's going to take care of you in the hospital when you're old, right? Like, we need workers. Who's going to support the pension system? So clearly we need a healthy level of immigration. Full stop, end of discussion. Okay. Anybody who says otherwise is just ignorant of the stats. Now, that said, I tremendously resent this idea that we can't push back at all against this arbitrary 500,000 number that's been just like pulled out of a hat, right? And is that the right number? Like, I don't know. We don't know if that's the right number, but we can't even have this discussion, right? And even more than that, what drives me crazy is that's one component of population growth. But then you've got non-permanent residents, which are things like international students. And there's no limit whatsoever on that. And to me, that should be encapsulated in an overall population strategy that takes into consideration our ability to build the housing necessary to accommodate that growth.
Well, you're not going to find disinterested people here, John and I. I'm sure you know, especially John has been speaking about this for quite some time. And I think coming from sort of, let's just say, a more neutral view, there's a greater issue too. I would call Canada one of the great immigrant countries. Like the number of people who are either born outside or have a parent born outside is just phenomenal. It's such a high number. It's something like 70% in the GTA with those two combined. The idea that we can't talk about how people are doing, either the people that are already here or the people coming, because of fear of these labels, is really damaging, because a lot of the times it's these foreign students and other factors. On one side, they're not discussed because we fear xenophobia. On the other hand, they're not discussed. So you see people, and we've seen stories of, really bad student rooming houses, students paying phenomenal amounts for their degrees here, while housing is, totally out of their reach and rents are skyrocketing. So we agree with you, Ben.
Well, it's one of those things that doesn't have to be difficult, right? It's like if you're a university and you want to expand your international student enrollment by 10,000, it's great, wonderful. Where are you going to put everybody? Like, how are you going to accommodate them without having a negative impact on the local rental market? And let's remember that universities and colleges have a tremendous incentive to expand their international student enrollment because they pay much higher tuitions. And that's fine. If you want to take advantage of that loophole as a post-secondary, fine, right? And we do. Listen, it's a net benefit for Canada. We attract a lot of international talent. Much of those people stay here. So we end up being like a sink of talent globally. And that's a good thing over the longer term. But universities and colleges should not get a free pass here, right? You want to expand that, fine, but show us first how you're going to meet that need, right?
And be responsible.
That's just common sense.
Yeah. Responsible for those students and their experiences. Yes, John, anything to add? I know.
No,
I'm speaking to the choir here.
I'm good.
Just to touch one last point about this, the whole idea of housing lack of supply, the unaffordability. I was really shocked, Ben, and I think John, you were struck by the fact that you said in your report that Canada is building more homes per capita than any time over the past 70 years, and it's above the last peak reached in the 1970s. That's interesting, because I've interviewed others who are saying, listen, we think we're building a lot. You see cranes everywhere, but it's nowhere the amount we used to build. This suggests otherwise, that we are building.
You get into some nuances with the data. So first off, that's just comparing the homes that are under construction relative to population. Okay, it's a slightly different chart if you look at housing under construction relative to the population growth every year. You understand what I'm saying? And so that's one thing. Now, the other thing I would point out is there's a difference between housing starts and what's under construction. So housing starts have been, I don't want to say they've been trending lower. They've actually been quite high over the last, year or so. But prior to that had been well below levels that we'd seen over the past decade. And in spite of that, the number of houses or number of units under construction kept going up. Well, why is that? Because we kept skewing towards larger and larger condo buildings, purpose-built rentals, things that take longer to complete, if that makes sense. So you're almost like you're stacking up this like stock of units that are under construction, even as the flow of new housing starts were falling. I know that's a weird concept. And so it's like anything else. It's like if you take a bunch of data sets, if you torture them and look at them one way or another, like they'll eventually confess to whatever you want them to confess to. And so it's very easy using that data to make an argument that either we're underbuilding or overbuilding. What I think the fair way to look at it is, if you're looking at single family particularly, it's really difficult to make a case that we have overbuilt by any means over the last decade. Now, cyclically, are we going to see a downturn where we probably have more supply than we need? Yeah, I think so. And that's probably going to last for a little while longer. Where there's arguably some overbuilding is more in the multifamily space, and in particularly as it relates to condos. And there's some question about what that market's going to look like as those units start to complete. We saw projections for 32,000 condo completions in Toronto this year. I don't know. We don't know what that market's going to look like as those units finally come online. And so that's what I was trying to point out. There's a lot that's going to need to be absorbed as we go forward.
So it seems like you're just saying it's kind of like a stutter start. Like it doesn't expand, or the larger condo building projects, they don't respond as quickly. You start building, you don't see everything completed as regularly as you would with single family. So you got to think about that. And now we're seeing that I think the number was, sorry, John, did you say 18,000 of those in the first half this year? Urban Nation was saying?
I think Urban Nation said, yeah, we're expecting over 30,000 completions and 18,000 of them in the first half of the year. And that's in the GTA.
So what do you guys think? Any chance that we'll see a shift in condo prices as a result of this?
I don't think so.
I'm going to put that one to John. What do you?
I mean, I don't think it's going to have a big impact, quite frankly. I think we'll see more of those people, probably some of them list because either because they can't close or they did close and they're paying 5% on their mortgage. But the market's so tight now. Like even if we see, whatever it is, 20% of those get listed, I don't think that's enough to have a deeply negative impact on the market personally. And I think the rental demand is still strong. So I don't know. I'm not overly pessimistic about these 30,000 completions. I think most of them have made money, and we'll see some distress, but I don't think it's going to be big personally. But we'll see.
Ben?
Well, I think that it's going to take some of the steam out of the rental market. We're already starting to see that. You're starting to see condo leases in central Toronto are down about almost 25% year over year in the fourth quarter. So you're seeing some demand is starting to come out of the rental space at a time where you have a lot of condos, which we know a lot of new condos enter the rental market, as well as a lot of purpose-built rentals coming online. Right. So to me, that's the big takeaway. I'm more confident that it'll take a bit of steam out of the rental market than I am around what it may or may not do to resale prices. I think much of that's going to depend on the trajectory of interest rates, right? Because as John said, like this is not a dramatically oversupplied market. That's one of the curious things. We're 10 months into the worst downturn since the 80s in Canada, and inventory levels are not particularly high, right? So there's some room potentially to absorb these new units. I don't know, but if rates are 5.5 and you get some distress around completions, yeah, like you could see some more pain. I suspect in that space. I don't know what you'd constitute like a disaster by any means, but yeah, it's not hard to get to a spot where prices come down substantially from here.
Also, disasters in the eye of the beholder. I mean, if you're looking to get in a slight, could we see a drop in prices enough to soften the impact of, like you were saying, that persistent, higher interest rate environment we're now in?
So we're actually getting to the point now, because I track this monthly, we're getting to the point now where affordability is improving. I know it doesn't feel like it, but if you look at what's happening with mortgage rates, they've effectively been flat for the past couple months, and prices keep coming down, right? And so, and incomes are still growing. So affordability is actually getting slightly better. Now, that's after getting dramatically worse, right? So it's like, a modest improvement off of like a really nasty trend. But nonetheless, it's getting better, right? So I don't know. I'm not sure what's going to be happening with prices going forward. But what I do worry about specifically to the condo spaces, I just don't know. Like I don't understand. For the longest time, I had a hard time with the idea of buying a cash flow negative condo, right? Which we know was like the big thing, right? And most investors were having to pay out of pocket a few $100 a month. And that never fully made sense to me, but I understood the math, because when rates were relatively low, right? So under 3%, let's say, you had about half of your mortgage payment going to principal from day one. So let's say your mortgage payment was, $2,000, and you were out of pocket $300 or $400 a month. But $1,000 of that mortgage payment was going to repay the principal. As an investor, you could justify it. You could say, yeah, I'm out of pocket a bit, but I'm making $600-700 a month on the principal repayment. You look at where we're at today, with rates where they are, with prices where they are, where rents where they are. If you buy in this market at 80% loan to value, like not only are you looking at a massive negative headline cash flow of, by my math, about $2,000 a month, but even when you add back the principal repayment, like you're massively negative. So to me, that's the one thing that worries me about the condo space, is just like it's been so reliant on investor demand, not exclusively, but it's a major player. Investors are a major player. I don't understand what incentivizes investors to step into this market right now. And maybe that's where John could come in.
Yeah, John,
Yeah.
there was a headline. I think you were interviewed saying, is it just wishful thinking?
What wishful thinking? That
Well, you were thinking, I think the story in the media I saw,
that
I don't know if
investors
you
are holding on.
they're holding on and
Yeah.
maybe too long.
Listen, so there's the investors who've had their units for years, who have money, who just don't want to sell because it's made them so much money and they want to hang on. And even if their rates are going up, they're just bullish real estate. And I got to be honest, like it's we're in New York with a couple of our agents. We were having dinner last night and we were just talking about the market, and all of us were shocked that we're getting calls from investors, right? Which to me is just mind blowing. And I'll clarify, not all of them are looking at going and buying. Some are looking at buying very affordable condos, but many of them, it's like, have homes, need to upsize, and they want to keep their current properties as investments. To me, that's like an investment decision, right? And it's fascinating. It's still strong. People are still bullish long term. Like whether they can afford it, to Ben's point, it's a lot harder to make those condos work at 5% mortgage rates. Like you're burning cash. And you know, and it's funny, like Ben's point's right about being cash flow negative. This is why our market's driven by mom and pop investors. Institutional investors do not bleed money every month on their properties. Like it's just, it doesn't work well. You know what I mean? That's something that mom and pop investors will do because they, you know, it's part of their retirement. They just budget it. They spend less, you know, they take some of their, you know, their income to contribute to the mortgage, and that's what's been fueling it. And I think Torontonians are still bullish real estate, which is, you know, even in this high rate environment. How many can afford it, we'll see, but it's going to be a lot harder for sure.
And John,
Yeah,
just to clarify, sorry to jump in, but just to clarify, like, are these investors that are like, hey, if you come across distressed assignments or some are distressed, like, are these distressed investors, or are these people that are like, bring me a condo and I'll buy it and rent it out today? Like,
yeah, kind of like that. You know, like I have some money, I have 150 grand. You know, can we get a condo for, you know, $600,000 or something like that? You know, and you do the math for them, and they're like, okay, you're going to be short, you know, 800 or 850 a month or 900. You know, and that, they do come back that, wow, that's a little much. I was hoping I'd only be short 500 a month. You know what I mean? But the point is, you're having these discussions, which to me is fascinating, right?
Yeah.
Yeah, I mean, to be fair, I mean, 2 points there. One is, I think I'm learning that the financialization of real estate, you know, we think of foreign capital or other things like that. There is a component in Canada where it's just become part of your financial planning. To invest in real estate. So it's not always big bucks, but enough of those bucks in enough hands, and you know, you start to see a big trend. So that'll be interesting to see, you know, if there's any change there. The other thing I'm wondering about as well is, sorry, I'm sorry if you guys saw that. What you think in terms of the rest of the market. So I think, Ben, you were talking about in April or March, April, you expect to see more listings, because in general, you're talking about how inventory levels are pretty low. Well, part of that story is that while sales have, you know, plummeted, in some cases, the lowest volumes in 12 years, listings haven't come onto the market. So people haven't been, you know, people have held back on listing their homes. And I know that you're expecting that to change in the spring. So I'm wondering, you know, why you think that might change and what you think that might entail.
Well, I think it's an open question right now as to whether the drop in new listings that we've seen, which has been really pronounced, whether that's indicative of sellers that have exited the market completely, or whether it's just delayed those listings coming to market. And I don't know the answer to that. I suspect that we're going to see a very high level of new listings this spring, for a number of reasons. One is just, you know, I think probably we've just delayed these new listings. Like if you look at what's happening in the fourth quarter nationally, we had the lowest level of new listings since 2010, outside of like the 2 quarters during COVID when everything was locked down, which you kind of throw those out because it doesn't really count. And so there's no listings coming to market. And so you would expect that some of that'll be just, people who thought, well, maybe I'll sell, but I'll wait for the market to pick up in the spring, right? And that's one component of potential sellers. But the other one that I think is more interesting is the people who are going to have to start to sell, right? There is a component of people who are with non-prime lenders, private lenders, people who are renewing 1-year loans where their mortgage rates are going from literally 3.5 to 8, right? Or 3.5 to 7, like major jumps in rates. And if you're an investor, like that really does a number on your cash flow. And I do think you're going to see some of those listings start to come to market. So I think we're going to see very strong flow of new listings. Now, offsetting that though, I want to be really clear. I think that we're going to see sales start to move higher this spring on a seasonally adjusted basis. Like I think we'll see home sales nationally probably jump 20% off these lows, right? And part of that is just, we've finally got some stability, some signs of stability from the Bank of Canada. So people no longer have to fear of like, well, maybe the mortgage rates are going to go to 10 or 12. Like the Bank of Canada is kind of telling you probably not. And I think that there are people that were waiting on the sidelines for that stability and will start to step back in. But it's important to note, like you could see sales bounce 20% from these levels and still be 25-30% below peak levels. So I'm not projecting that we're going back to anything like 2021, early 2022. And so I think both of those things are going to happen. You're going to see a lot of new supply and you're going to see sales bounce a little. So how that all shakes out in the market is a bit unknown, but I don't anticipate that this market's just going to rocket back to the highs by any means. But John may have a different view on that.
I mean, I don't think we're going to rocket to the highs, but I mean, it's funny. I started the year, certainly a little bit more cautiously, I don't say pessimistic, but obviously all of the downside signals that we've talked about. I mean, recessionary, like there's so many variables, and but the start of the year is not starting the way I expected. The demand's stronger than we thought. Inventory's still tight. Like it's very competitive. The sentiment is not negative from buyers. Like the negative sentiment is, holy crap, there's nothing to look at. I have to compete with so many people on the one nice house that came out on the market, right? And it's just really interesting. And I think it's hard to say where the market's going to go, but I think the probability of further declines, at least in Toronto where we are, is probably less than what I originally thought, just because and even I agree with Ben, like we'll see more inventory. I don't know if it's going to be enough to kind of meet the demand that we're seeing still, which to me is fascinating. Like that there's still so much demand with rates as high as they are. People getting stress tested effectively at 7% now. Just like it just kind of blows your mind. You know what I mean?
Do you think, I'm starting to wonder, like, do you think it's these mixed signals? So on the one hand, if you can weather this period, somehow have those investment units even at a loss, as long as you don't become distressed and you don't have to sell. If you can hang on, then you're hearing about these 500 a year population targets, 500,000 a year. In the long term, you're hearing about long-term shortage problems coming back. Yeah. So is it a bit of that? Like if you can 100%. Hang in on the short term, everybody's like,
this is why people aren't selling. Like this is why no one's listing. Investors are holding on. They're renting their properties out again. Like people are very optimistic for those exact reasons. They know supply will never keep up. They know that this idea of building 1.5 million homes in Ontario is just impossible. Like you can't triple housing completions. So they just see upward pressure on rents and home prices. And I think that's what's fueling a lot of the enthusiasm from investors.
So is it
also important to note, sorry, I just want to jump in, but it's also important to note, like every housing cycle, and I don't even use that term because we really have not seen a housing cycle in Canada since the 80s, but every little mini downturn that we've seen has been kind of 6 to 9 months. Even 2009 was a blip, 2015, 2017, 2020, all of those times. The message that's become ingrained is you just hold on and you just kind of bite the bullet and you wait for 6 or 12 months and you're right back to the highs. And that's, I think, in the back of everyone's mind here in Canada. We've been conditioned that that's what a housing downturn looks like in Canada. Now, I'm not convinced that that's what this one's going to look like longer term. I do wonder if 5% rates aren't going to take some steam out of this market for a longer period of time. But I just don't know. I agree with John's sentiment. Like, it is surprising that you're still hearing of all this demand with rates as high as they are.
Well, I mean, this is the observation that I'm thinking about as well. You know, Ben, you mentioned that the downturn in the late 80s, early 90s, it's not just the magnitude. The drop was bigger, I believe, from peak 25% or something like that. And it was took 10 years to recover. Now, you consider that, and then consider our experience, even ourselves. We were in this real estate space. We lived through 2008. And then, you know, and COVID after 2020, it seemed like as soon as Canadians realized it's not going to be as bad as we thought or whatever, they just rocket back out there into the housing market. It's just become our thing. It's almost like a college student's hangover next Friday night cycle, you know, like you're just not getting this sense. And I'm wondering, what is the potential for that to happen? Again, I'm asking for a friend. And I know I can't time the market, but when is there a bottom before buyer excitement takes over? And that's what I'm wondering. I'm wondering if we will see, like Ben's saying, you know, he wouldn't be surprised if he sees sales rebound. Personally, I wouldn't either. You know, does it take a lot for Canadians to get excited again and rush back in? Or are there new factors this time? Is the interest rates, you know, a new factor? Or is the tightening of lending that's going to happen a new factor?
Well, I want to be really clear. I feel quite strong that sales are probably bottoming right now. I don't anticipate that we're going back to the level of demand that we saw in 2021, 2022. And so that's one thing. So you have to remember, in Ontario, we're seeing some metros have the lowest level of sales since the 1990s right now, again, outside of those couple months during COVID. That's just unsustainable when given population growth, right? And so it's artificially low. Can it bounce 20% from here, seasonally adjusted? Yeah, absolutely. But that still leaves it way below the levels that we saw in 2021 and 2022. That's one side of things. But if we also see a very strong supply response, and that means the market stays in this kind of, you know, balanced to slightly buyer territory, right? I think we've definitely, at this point, I think it's quite like we've seen the worst of the price declines, right? And we may grind sideways to slightly down. I don't know if rates get into the high threes, maybe we see prices take back off again a little bit, but you know, I think it could be a while before we recapture those highs. One other point on prices, people don't realize this is already the worst housing downturn from a price perspective we've seen since the 1980s, right? We've already exceeded the peak trough decline we saw in the financial crisis. And we've actually exceeded the price decline we saw in 1989 off of that peak. Now, that's hard to believe if you lived in Ontario through that downturn, because that downturn was much more severe in Ontario. It was about a 25% peak trough decline. And as you said, it didn't recover those highs for a decade. That's like unfathomable for people today. But that was the environment back then. So, you know, this is already a pretty substantial housing downturn that we've seen, right? I don't know where it goes from here, but it wouldn't shock me to see prices grind sideways or down for another year or longer if rates stay high.
So you
Okay,
mean
so
nationally we're the worst since then is what you're saying? Okay, that makes sense.
Yeah, you got to go back to the 70s to find a house price decline like this, right? Which is all pretty shocking. But again, that's, you know, it's tricky because if you isolate Ontario, it was way worse in the 1980s, right? Early 90s.
Yeah, I wonder if mentally that makes a big difference. I think we do remember our parents going through that. At least I do. Our friends' parents, and maybe because we haven't seen that duration since. I just wonder if our mentality's changed a lot. John, you've written a lot about, you know, the introduction of psychology to economics and housing markets. And, you know, I'm tying back to what Ben said earlier. You were saying things happen really quickly. They don't go up slowly and down slowly. They go very quickly. Buyer sentiment, developers have to respond to it, builders do too. I think we are seeing that. This is a very sentiment-led sector. And I'm wondering, like, am I crazy to think there could be some kind of post-2008 or post-COVID situation where people just get excited again if a recession doesn't come or is not as bad as they think, and things just go sideways rather than down?
Yeah, I mean, I think sideways is the most likely path. Like, I don't think we're going to see a lot of exuberance with rates, even in the fours. You know what I mean? But I do think we're seeing optimism. Like, even the people we see on the ground, like, they're not freaking out. They're not like going out buying a home worried, oh my God, price. They just want a home. You know what I mean? And the sentiment is not pessimistic. And even if prices fall a little bit, they don't care, right? So I do think we've hit this behavioral shift where, at least for most people, the pessimism is behind them, but that doesn't mean, you know, even now with, you know, multiple offers, it doesn't mean people are paying stupid prices. You know, they're paying reasonable prices, and prices might grind sideways for a couple of years at least, right?
Oh,
And I
right.
think that's a very likely path with rates this high. It's hard to see prices rising, you know, 15% per year when you're paying, you know, 4 or 5% on your mortgage.
Right. So a way to think about it is you might be exuberant, but what we had before was conditions in which your exuberance could be matched with your ability to
Exactly.
get low interest rate
That's a
mortgages,
good way
the
to put it.
lending. Yeah,
Yeah.
and now there's a tightening of not only lending rules, there's gonna and so now we might be exuberant, but our bank accounts are reining us in a little bit. Is that a good note to end on? Is that what we think we can expect to see? Both of you over the next few months?
Yeah, like I said, I think we're going to see sales bounce this spring. I think it's going to be met with a lot of inventory, and how that all shakes out, I don't know. If rates stay high, I could easily see another 10% come off this market. But if in fact we get down to kind of the 4% range in mortgage rates, then we'll probably see a low in prices in Q1, and it'll start to stabilize. I don't think we're going back to those crazy boom times of 2021. But listen, I've been surprised before, so who knows? I'll flip it over to John.
Yeah, I mean, I agree. I mean, I'm not as especially if we see 5-year mortgage rates hit the fours. I think that's going to probably put a floor on prices, quite frankly, this year. Again, I don't think it's going to be a you know, 10% growth in prices, but you know, we could see some slight increase if we see an acceleration demand. And if the new listings don't pick up aggressively, because we need a lot more listings to put downward pressure on prices, or at least keep price growth stable. So I think that's kind of what we're looking at in the year ahead.
So can we plan to talk in a couple of months again, Ben? Yes, not even
Yeah,
6.
absolutely.
I'm
Right.
targeting March, April, because
All
we
right.
want to see if those listings do start to show up, you know, and if not, why? And we can go through all of Ben's fun charts again then. I
I'd be
really
happy
do.
to.
I love your reports, Ben. So
Awesome.
thank you so much for sharing your valuable insight, and John for adding your thoughts. Thanks to all our viewers and our listeners as usual. You can reach me at editor@movesmartly.com, or leave us any feedback at our channels, YouTube, Twitter, podcast. Leave us a review. No feedback, just a great review on podcast. And we'll talk to you all soon.